Imagine waking up one day and realizing you've spent 10 years working hard, but your money barely grew. Not because you were lazy, not because you didn't earn enough, but because you invested in the wrong order. This is one of the biggest mistakes people make. They hear about stocks, crypto, real estate, index funds, and they jump into whatever sounds exciting. But building wealth isn't just about what you invest in. It's about when. The order matters a lot. Think of investing like building a house. You don't start with the roof. You start with the foundation. And if the foundation is weak, everything above it becomes risky. So let's walk through the smartest order to invest your money, step by step. Starting with the first move almost everyone overlooks.
Step 1. Build an emergency fund. I know, this isn't exciting. Nobody brags about having cash sitting in a savings account. But this single step protects everything else. Imagine investing every dollar you have. Then your car breaks down, or you lose your job, or a medical bill shows up unexpectedly. Now, you're forced to sell investments at the worst possible time. That's how people destroy years of progress. An emergency fund prevents that. Most experts recommend 3 to 6 months of essential expenses. Not invested, not locked away. Accessible. Think of it as financial armor. You hope you never need it, but you'll be glad it's there when life gets expensive.
Step 2. Capture free money. If your employer offers a retirement match, take it immediately. This is one of the closest things to guaranteed returns you'll ever find. Imagine putting in $1 and someone instantly adds 50 cents or even another full dollar. Most investments can't compete with that. Yet millions of people leave this money on the table every year. Don't be one of them. Always collect free money before chasing bigger opportunities. Step 3. Eliminate high-interest debt. This is where many people get confused. They invest while carrying credit card debt charging 20% interest. Think about that. If your investments earn 8%, but your debt costs 20%, you're moving backwards. Paying off high-interest debt is often equivalent to earning a guaranteed return, because every dollar of interest avoided stays in your pocket. Before building wealth, stop the leaks.
Step 4. Invest in broad market index funds. This is where real investing begins. Many beginners think successful investing means finding the next big stock, the next tech giant, the next millionaire-making opportunity. But history tells a different story. Most professional investors fail to consistently beat the market, and they do this full time. That's why broad index funds have become so popular. Instead of betting on one company, you own hundreds, sometimes thousands. You're investing in the growth of entire economies, not a single guess. Over long periods of time, this approach has created enormous wealth for ordinary people. Quietly, consistently, without headlines.
Step 5. Maximize tax-advantaged accounts. Taxes are one of the biggest hidden costs investors face, and most people pay far more than necessary. Retirement accounts exist for a reason. They allow your investments to grow more efficiently, sometimes tax-deferred, sometimes tax-free. Over decades, that difference can become enormous. Two people can earn the same returns, but the one using tax advantages often ends up significantly wealthier. Not because they invested better, because they invested smarter.
Step 6. Increase your investment rate. Most people obsess over returns, but returns aren't always the biggest factor. Contribution rate often matters more. Imagine investor A earns 12% annually. Investor B earns 8%. But investor B invests twice as much money every month. Who wins? Often, investor B. because wealth grows from both returns and contributions. Focus on increasing the amount you invest. Every raise, every bonus, every extra source of income, let part of it flow into investments. Lifestyle inflation is the enemy. Investment inflation is your friend.
Step 7. Consider advanced investments. Only after everything else is in place. This includes things like individual stocks, real estate, small businesses, and other specialized opportunities. Notice something. These come last, not first. Many people start here, and that's why they struggle. Advanced investments can create substantial wealth, but they also introduce additional risk. They work best when built on top of a strong financial foundation, not instead of one.
Now, let's put everything together. The smartest order looks like this. First, build your emergency fund. Second, capture employer matching contributions. Third, eliminate high-interest debt. Fourth, invest in broad index funds. Fifth, maximize tax-advantaged accounts. Sixth, increase your investment contributions. Seventh, explore advanced investments. Simple, logical, powerful.
The truth is, wealth rarely comes from one brilliant investment. Most millionaires didn't become wealthy because they found a secret stock. They followed a system, year after year, decade after decade, while everyone else searched for shortcuts. The smartest investors understand something important. Getting rich slowly is usually faster than getting rich quickly, because the people chasing shortcuts often lose time recovering from mistakes. So before asking where to invest your next dollar, ask something more important. What's the next step in the sequence? Because investing isn't just about making money. It's about building a structure that can survive uncertainty. And when you follow the right order, every dollar starts working harder. Not just today, but for the rest of your life.